be here. Are you guys excited this morning? I want to see you in the chat. Are you guys excited? Good morning, everyone. I'm excited to be speaking to you today. My name is Charles, and I need you guys to be excited. I need you guys to, coming here today to do things. And I thank you, David, for giving me the opportunity to speak to these amazing people. I'm just excited. And we're going to be communicating. I need this to be interactive. These are the things that have been used in this country to change lives. And we want to change that today. I need you guys to tell me where you're from. Tell me where you're from. Send it in the chat. Thank you. Thank you. Thank you. Tell me where you're from. Excellent. 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 And then the second thing I want you to tell me, are you? Yes. Thank you. Thank you. Thank you, Ian. Thank you, Ahmed. Thank you, Matt. I appreciate that. The other thing I need you to tell me is, I want you to tell me in the chat, are you a business owner or a W-2 person? I need that in the chat as well. Please tell me. Excellent, excellent. Business owner, W-2, business owner, W-2. Thanks, Ian. Thank you, guys. Thank you so much. One thing I'm going to tell you today is I'm not the best in IT. So I'm going to be a little bit wobbly with my presentation, but the key is there. We're going to have the matter. I'm not the best at this. That's why I have people helping me with these things. So another thing I want to know today, yes, like I said, I need energy in the room. I don't take your time for granted. I want to give you the best. If you have any questions for me, please type them in the chat. I need you to type all your questions because you came here with a purpose. You came here, you wanted to leave here with something. And we want to make sure that you leave here with that thing. Every presenter is going to make sure we give you that thing. So we are going to tell you today how America works. We are going to tell you over the next 40 minutes, I'm going to tell you what's the biggest weapon that Americans, the wealthy, have used over the years to build generational wealth for their kids the right way, to build generational wealth for their family in the right way. And some of you here are going to leave with a free wealth assessment today because you were engaged, because you were part of this conversation. So please be engaged. Please be engaged. So I'm going to start by sharing my screen and tell me when you see my screen. David, my screen is disabled. Can someone allow me to share my screen? Hi, Elaine. Hi, Jason. Hi, Matt. Excited to be with all of you today. Hi, Tony. Yes. Thank you, Steph. Thank you so much. Thank you. Thank you. Now, tell me if you see my screen. If everything is okay, tell me. Give me a thumbs up in the chat, please. Thank you. Thank you, Elaine. Thank you, Matt. Thank you. I have some people in the waiting room, so please allow them in. So today, like I said, I'm going to be talking about how to build generational wealth by employing family members. And the key thing here is doing it the correct way. Because many a times people don't just do it the correct way. For those who know how to do it, I'll start by warning. This presentation will have a huge impact on your future. You're going to be exposed to some concepts and ideas that will change the way you think. It's going to save you on taxes. It's going to improve your net worth. And it certainly will change the way you think forever. I know what I'm talking about. So basically, I'm going to give you some tips, key tips here. Turn your video on, please. I need to be engaging with you guys. Turn your video on. Be engaged. Be engaged. Get your workbook and your pens ready. Take notes. Close the rest of your tabs. You came here for something. We want to leave with those things. I want you also put your phone on Do Not Disturb, so that by the time you leave here, you get the full scale of what you came here for. And again, be engaged. Ask as many questions as possible. We are going to answer all of them at the end. So please bear with me and thank you for being here. Now, you may be asking, who is this guy? My name is Charles Njoya. I'm a husband to a wonderful lady, the lady of my heart. I'm also a father to 4 amazing kids, Shalanda, Victoria, Nathan, and Lily. Praise. This is my world. I've been in the profession, accounting and tax industry for the last 26 years. And most of the time, I was helping the wealthy. So that's why I can talk about this. I'm a former PwC director. For those who don't know, PwC is one of the top largest, the big four tax and accounting practices in the world. I'm a CPA and I'm a tax strategist. I'm the founder of a company called CHN Advisors, and where we do tax and estate strategy. Office is located here in the Woodlands near Houston, Texas. Now, why do I do this? For the last 17 years at PwC, what did we do? We were working for the most affluent and the powerful people, individuals and corporations. And we had one goal: help structure and build these guys' wealth. That was the goal. And the primary component of building this goal, of making this goal, is taxes. We analyze the tax code to suit every little investment these guys are making. We save them hundreds of thousands and millions of dollars in taxes, giving them the best structure to build and sustain their wealth and to pass it on to generations tax-free. And for many years, I thought that was the standard for everybody until I left PwC and moved to a mid-tier firm in a smaller firm. And then I realized the focus was completely different. The focus there was mainly on what? On compliance, meeting deadlines, making sure that clients pay estimated taxes on time and to avoid penalties. That was the aim. But why would the focus be on deadlines instead of having the focus on what these people are creating the business for? Save taxes. That's what we did for the big companies. We saved them money. You want people to get where they want to go. That was the aim. But when you do that in the middle class, most CPAs, when you talk about that, it's all reluctance. People are reluctant about that. And why are they reluctant? Because CPAs are not tax strategists. That is not their job. CPAs are what we call tax accountants. Well, I remember working for a dentist when I was working for the smaller firm, and we had this dentist that we were working for, and he had this tax bill of over $320,000. We ended up saving him some money. We saved $97,000, but we could have done a lot more. But the firm won't embrace that, because that's not just the mindset of every CPA. The society wants us to understand is that we are there. CPAs are there to help you pay taxes. But the aim is different. And for me, having spent my last 17 years helping people avoid taxes, I hated it. That was a big problem for me. And changing the mindsets of people to start thinking that way is not so evident. It's hard to do that. So basically, the problem of the middle class is they do not know how America works. That is the problem we have. If all of us here knew how the system works, I know one thing, and we practice it, we will all be in the top 1%. Why? Because the middle class is the hardest working group of Americans. That is it. So we have to shift our mindset. That is our problem. And when I was in a smaller firm, it was harder for me to do that. I had to change. I had to move on because it was hard to change the minds of people who are so used to. We are taught how to help people pay taxes as CPAs. We are not taught how to save taxes. The mindset of the top 1% is they don't want to pay a dime in taxes. When they work with you, their mindset is that way. America is a capitalist country. Capitalism means we focus. It means that someone, the government, owns nothing. The government doesn't own anything. So my mission has always been to help the middle class Americans to know how America works. That is our mission. And that's why I had to leave the firm and I created my firm. I brought in the right team because this is about a team. It's not about a person. So we can help build their economy, as someone says, so they can access the American dream. We're here to access our American dream. And how do you do that? It's something called the tax code. Most people are made to think that the tax code is there to help you pay taxes. That's what they make you to think. The tax code is actually there. It's a system. The system is making you believe that the tax code is there to make you pay taxes. But that's not true. Remember, capitalism is a system where the government owns nothing. They don't own anything. Basically, that same government needs everything. So they want you to do certain things. They want you to build roads, to build affordable housing, railways, jobs, commercial property, residential property. They want you to do all of these things, affordable housing, charitable organization. They want all these things, but the government owns nothing. Now, how do you have to do this? So they use the tax code as an incentive to make you do these things. The tax code is there to help you do what the government cannot do. Now, you pay a lot in taxes when you do not do what the tax code wants you to do, what the government wants you to do. And remember, all the things I showed you there, they are those things that are called assets. They help, these incentives are there to make us wealthy. I know many people are asking the question, I own property, I own real estate, I own this, I own that. Why am I still paying taxes? The problem is in structure. Structure is everything. If you own real estate, you're hiring people, you have jobs, you're creating all these things, and you're still paying taxes, then you have a problem with your structure. And that is why you need something called a wealth assessment. And that's something we will do for you. That's something we are going to do for you. Are we communicating? If this is making sense, I want to see you in the chat. Say yes. If this is what you're coming for, I need to hear you in the chat. If this is not, you tell me, because we're here to communicate. Thank you. Thank you. Remember, I said a CPA is not a strategist. That's why the wealthy do not pay income taxes, because they are using the tax code to do those things that the government wants them to do. Now, while the smart Americans are building wealth for themselves and making the country wealthier, the middle class is there paying the bills of America. What do the middle class do? They fund Social Security. They are doing what? They are funding Medicaid. They are funding food stamps. They are doing all these things, funding benefits underprivileged, etc. The middle class does so by paying taxes. Someone is being screwed. It is called the middle class. We don't want to be part of the middle class. You don't want to be part of the middle class. You want to be the part of the top 1%. Now, my key here, remember, we're talking about the right way to build generational wealth, employing kids the right way. The American dream is alive. And what is the American dream? We want to make money. We want to keep the money. We want to build assets. And remember, assets is wealth. Income is not wealth. When you make a lot of income, you tend to pay a lot of taxes. But if you are able to leverage that income and build assets, you're building wealth. That is what wealth is. When you make income, you pay taxes. Assets don't pay taxes. I'm sure some people are asking, what is he saying? But that's the truth. And one other thing you want to do, you want to transfer those assets across generations. That's what the wealthy do. That is what we call the American dream. And one of the bases is employing your own kids. How does that work? We do that by leveraging the tax code. This is something that is clear in the tax code. Now, let's see what the IRS says about all of this. The first thing is that it says that payments for the child services are subject to income tax withholding regardless of age. If you look into that, it means that you're going to pay income tax. You're going to pay income tax and withholding taxes for that child. But it goes further to say, however, if the child is under the age of 18 and working for a parent, underline that, and working for a parent in a trade or business, payments are generally not subject to Social Security or Medicare taxes. That's important. I'm sure you're sitting there and saying, I don't own a business. Does this work for me? Because this is all about working in a trade or business. It will work for you if we can do an assessment for you, because there are ways we can structure you to own a business and take advantage of all of that. And you will hear those ways as part of our discussion in our meetings today. So again, what does the tax code say? It says further that if the child is under the age of 21, payments are not subject to FUTA. So think about this. We said there's the age of 18, and then it goes further to say, if the child is under the age of 18, you don't have to pay self-employment taxes. So between the ages of 18 to 21, you don't pay FUTA, which is federal unemployment taxes. It goes further to say, however, if the business is structured as a corporation, an estate, or a partnership, where only one of the parents is a partner, then you must withhold all of these taxes from the child's wages. You see, it's a little bit tricky. If you look at all of these things, they are kind of ambiguous, but it makes sense. And that is where we're going to go. What are the implications of all of this? Let's look at the implications. Number one, work. It talks about work. What does work means? It means that that child has to do actual work, and that work has to be monitored. Whatever the child is completing as work, you have to keep it. I've seen people who just write off standard deduction and say, okay, this is what I'm going to write during the year. The IRS wants you to document the work. So you might have timesheets that document what the child did for you. And we can give you those templates and help you prepare with. The second thing it talks about is age. Now, federal law prohibits employing minors under the age of 14. But when you think about it, it goes further and allows any age as long as you are the parent or the legal custodian of that kid. Most states have age limits for employing staff, not when you are a parent or a custodian, and you are the one supervising the work. And then another thing is that courts have upheld in different cases, courts have upheld the age of 7. So unless you can prove that that child who is under the age of 7 is providing something that's ordinary, reasonable work for that age. And there are certain things that we do that are basically straightforward. If you have a baby actor, then you can pay that actor. If you have a baby model, you can pay that model regardless of age, as long as you can prove that that child actually did the work. So age, it is clear that as long as you're the parent or the custodian, then that child can work in your business. Another one is this code section in the tax code. Code section 162A. What does it say? This child must provide services that are ordinary and necessary in the pursuit of income. What does that mean? Ordinary and necessary in the pursuit of income. It means that that child who is doing that work, the work has to be related to the business. I'm going to show you a list of activities that you can make your child do, and you have to pay that child reasonable wage. I've seen people who basically just write a check, and then they say, oh, when you try to do the math, it shows that the child is making maybe $100 an hour. Whereas you have different staff in that same company who are doing more complicated work, and they are being paid $20 an hour. So you want to make sure that's reasonable, the wage that we're paying the kid. Are we together? I want to feel that we're together. Guys, I need to see you. Thank you so much, Alex. Thank you. Are we together? Yes. Thank you, KJ. Remember, we are going to be giving awards for the people who are most engaged. We need to be engaged. So if you are the kids, if it's your kid, your grandkid, legal custodian, you can employ those kids. Now, let's look at the next steps. Let me see what type of work you can basically provide the kid. So we say ordinary and necessary for the business in the pursuit of income. Ordinary means it's something that someone else doing the same type of business can ordinarily be doing. Then necessary, it is necessary in that particular activity. You don't want to say, oh, the child did something that has nothing to do with the business. You can't write that off. The IRS, it won't go. They say also it has to be reasonable for the age of the child. If the child is a certain age, you want to make sure that the child will providing services that are reasonable for the age of that particular child. Very important. Cleaning, that's something that most people do. Social media marketing is one of the things that we provide, that you can provide your child, that your child can be providing for the business. Modeling, your baby models, you can do that. Data entry, very important. Advertisement, marketing, all those things. There are so many things that the child can be doing for the business. But the key is that you want to document it. The IRS is so particular about documentation, etc. You can name it. You must keep documentation of the work. Another thing, you have to pay the kid. How do you pay the kid? Remember, for corporations, partnerships, and estates, when we read the code, it said that if you are any of these, you are going to pay all those withholding taxes. I mean, it went further to say when one of the parents is the owner of the business. So what we do, we want to create a family management company if you have any of these structures to make sure we can pay the kids through those structures without having them pay Social Security, Medicaid, and all those employee taxes. The other thing you have to avoid, our aim is to avoid self-employment taxes. You want to create a bank account for the kid. Create a bank account. And the reason we want you to create a bank account is because this shows that it's traceable to the IRS. And not only that, what are you going to do with the money after that? it becomes very, very important. And we want to talk about that. And these accounts for children who are minor, it is actually an account that you are the one managing. It's called a custodial bank account. That's what it is. So it's called a custodial bank account because it's under you. So basically you're paying the child, but you can still have access to that account, and it means everything. You make payments to the account for the work performed. You just don't pay at will. You're paying for the work that has been done. You don't just cut a check at will. Make sure you keep documentation. Another thing is, what this does for you is, another thing, especially for those of us who are higher income earners, we're trying to shift income to the lower taxpayers. Remember, we're going to talk about some numbers, but this is so important. If I am making $500,000, $1 million in income, what that means is that I am in the 37% tax bracket. Now, if I have a kid who is working for my business, he will generally not be in that tax bracket. I can basically shift my income to that lower tax bracket. Even if I pay that child $100,000, it is still lower. It is still in a lower tax bracket than my own income. That's why this becomes a very, very powerful strategy. Another thing is, catch-up payments are not illegal. We'll talk about that. Another one is the structure allows the IRS to be paying your daily personal expenses. What do I mean by this? This is just a consequence of what you do. When you do that, some of us, we have to pay the school, we have to buy books, we have to do all these things for the kids. The kids simply work in the business, and now you're converting those things that would generally you have been paying from your own personal income. You're now making the IRS help you pay those things. Hey, are we together? Is this making sense? Is this what you're here for? If this is making sense, I want you guys to say yes. Thank you, Paul. Thank you, Ismail. Thank you so much. I want you to write your questions in the chat. We're going to answer your questions. Answer me. Thank you, Julian. Thank you so much. Thank you. I appreciate that. I appreciate that. So the key here is you're looking for a bucket where, number one, you're going to shift your income from a high tax bracket to a lower tax bracket. Now, your kids can work for you at any age, generally from the age of 7. And basically, not only can they work for you at any age, you can shift your income to those kids for doing work. And then now you can use that money to do those things that you would have done for them anyway. This is one of those areas. I mean, how to pay is one of those areas that I see a lot of problems. That is why you need a wealth assessment to help you structure this and set it right. Now, another thing I wanted to make here. So what's next? The question is, we have talked about the huge tax deduction. Why? Let's take an example. Let's say you out there, you have 2 kids, and then you're paying them standard deduction. I'm not going any further. You just want to pay the minimum here where the child doesn't have to file any tax. It's called standard deduction. Standard deduction for 2024 is $14,000. So it means that if you have 2 kids, you can basically make them work in the business. And as long as you pay them anything less than $14,000 per kid, they are not going to pay taxes. What does that mean? If you are sitting in that tax bracket where you're a 37% tax bracket person, that means that you have reduced $28,000 from your income. That is, you've shifted that to your kid. And then what is the tax saving? That child doesn't pay no tax on that money because it's below standard deduction. And then for yourself, you just save yourself $10,360 in taxes just by doing that. Just by doing that, you saved yourself $10,360. So there's a huge tax savings. The other thing you can do is, if that child, if you are in the high income tax bracket, you could make the child could still pay taxes on if you paid him over and above standard deduction. So what we do as strategy is you could even make the child pay as high as even $100,000. As long as their tax bracket is still very low compared to yours, you're still saving a huge amount in taxes, even though it's still household income. The other thing is that it is tax-free up to standard deduction. Remember, I told you $14,000 is standard deduction, and that $14,000 is tax-free for the kid. You just saved yourself $10,000, and for the 2 kids, you just saved yourself $10,000, and for them, they're not paying any taxes. So basically, that's tax-free income. The income, remember, I told you as well that you can basically, depending on your tax bracket, You are basically transferring your income from a higher tax bracket to a lower tax bracket as a strategy. And for 90% of us here, business owners, our children are already working for us. The only thing we're not doing is that we're not structured to take advantage of all of this. So we are losing a lot of money because every time we sit, as a parent, I'm a businessman as well. I always ask my kid, do this for me. Go and look at that. Go and look at that. If you can all document that and be able to structure that in a way that you're paying the kid, you just made the IRS take care of a huge part of your burden. And then this is the bigger part of it. You've made all that money. What do I do to the money? Remember, you've transferred, you've shifted that money. You've made sure that the child is paid to a family management company. The child is paid into the bank account. And then at times you don't really want to create, what do you call it? You don't want to make payroll for the child. One of the reasons you're moving away from corporations, all those S-corp and things like that, partnership, and building a family management company, you don't want to put that child on payroll because you want to make sure you're not paying any social security and all those things. As long as the child is under the age of 21 would be futile, but under the age of 18, you're not paying any self-employment taxes. So another thing is, once you have done all of that and you've transferred that money into the child's bank account, you've written a check out to the child, what do you do next? The next thing is, how do I invest the money? That becomes a big thing because that is where the top 1% have built crazy generational wealth for their families. And we have to do the same. And that's why this conversation is so important today. Let's think about this. First of all, there are high yield savings accounts where you can put the money in, which is far bigger. I mean, you're putting that money, it's tax-free money already. You can start saving the money for your kids' college, educational savings accounts. You can put those money there, 529s, you can put all those money there. But this is the big one here. It's called putting the money in a Roth IRA. Remember, the Roth IRA is after tax money. What does that mean? It means that if you paid the child anything under $14,000 for 2024, then you are not the money, even though you're not paying any taxes, is considered after tax money. So now you can put that money in a Roth IRA. And for 2024, I think the amount for Roth IRA contribution, the limit for IRA contribution is how much? $6,500. I think that's the number. If you were to put $6,500 for a child who is 10 years today, 10 years. Remember, we all live in an economy where the growth of our money or whatever we're paying is the interest is not simple interest. It is compounded. So you're putting $6,500 today for a child who is 10, and then that child can only access that money when they retire. Retirement is 59 and a half. Our aim is, remember, is to build generational wealth for our children, for our families. You put that money in a custodial. This is also a custodial Roth IRA. You put that money in a custodial Roth IRA. And what it does is that money is going to be growing tax-free. It is growing tax-free. What does that mean? The $6,500 that you put one time when the child was 10, when a specialist, when you calculate it by compounding that one time, by the time that child is retiring, that money is close to $1 million. That's the craziness we have here. And if you want to do something crazy, I just said that. So if you multiply that and you're putting that every year for the child, and then you're making sure that you're contributing to that child's Roth IRA, you've just created incredible generational wealth that is tax-free for that child. How many of us here have parents that created millions of dollars for us before we got to retirement? If you are the one, say yes in the chat. I'd like to see that. Tell me, are you here? Did we have that? Thank you, Dee. I mean, I wish I had that. How many of us have that? So the key here is to put that money in there. And once you put that money in there, second thing, for those of us who are in real estate, this is where you see the real value. You can basically take that Roth IRA and self-direct it. You have the money in Roth IRA. It is already growing at some crazy rates tax-free. And then the child only has access to it when they retire at the age of 59 and a half. Then, if you self-directed that money, you can invest in real estate. You can buy property for those kids. And what does that mean? It means that if you had maybe, let's say your Roth IRA for the kid had $100,000 that was there, you can self-direct that money, and then put it in real estate. Because when the money is invested in the market, it's invested in Wall Street, you can only invest in what they call stocks, mutual funds, or what you call what? ETFs. But now by self-directing, you just open the door to being able to invest in some other crazy ventures. You can basically invest in real estate. Take that money, you had $100,000 in the Child's Wealth IRA, they self-directed it, and then put it, now it's a down payment of $1 million property, assuming you put down 10%. So now you just multiply, and that is still part of that Child's Wealth IRA. That's the growth on that Roth IRA. And guess what? Who is now paying for the $1 million property? It is other people's money that you're using to buy that. Someone is living in the property and paying the property down for you. That is the crazy thing. So you just multiply that 100,000 tenfold by self-directing. And that's crazy. That's what the wealthy do. You can do the same. We should be doing the same. Why are we not doing this? Then now you just multiplied it, and it's still, the growth is no longer on 100,000 that was in that account. The growth is now on $1 million. And that $1 million has been contributed by other people's money. Capitalism is the key here. Remember, in a capitalist state, the government owns nothing. The government wants to own everything. They are incentivizing you to do certain things. And once you do those things, you don't pay taxes. The reason the wealthy don't pay taxes is not because the wealthy are not supposed to pay taxes. It's because they are doing those things that the tax code is incentivizing you to do. And if you do those things, those are the things that are called assets. When you invest in assets, those assets that are being incentivized in the tax code, you pay basically zero in taxes. And let me tell you something about real estate. Real estate is the one area in America where the government, where the tax code is inherently biased. It is inherently biased to investing in real estate. And that's why most of us keep store value in real estate. I think we have gone to the end of my conversation. I know that there are questions in there. And if you have questions, you can send them. We may be able to answer some of those questions right now. But what I want to tell you is this. I want us to do one thing. I want us to scan this QR code here. It will allow you to be able to book a conversation with one of us, with me, so that we can talk, we can structure this better for you. We can talk about how America works, how to structure your estate, how to build wealth in America, how to make sure that these children are building, we are building the American dream without doing anything different. What I just told you here, I didn't tell you, I told you, I showed you how to make millions of dollars for your kids without doing anything different. The only thing you have to do is structure. Make your kids work for you, structure them, and make sure that you're meeting all the rules as set up by the IRS. Because that's a clear advantage that's in the tax code. Thank you so much. I hope this was very helpful. And I know someone is going to get something from here. Let me see, Matt, what did you say? The income from the rental goes back to the Roth, tax-free? That's a great question. The income from the rental, everything that you're generating, it is tax-free because that is Roth. That's the investment. That's the growth of the money inside the Roth. You don't take advantage of it. The child doesn't take advantage of that while he's under the age of 59 and a half. Because if you do, you're going to do two things. You're going to be paying the taxes on it immediately and the growth. And you're also going to do what? You're going to pay a 10% penalty. Tell me, are we together? Thank you. I appreciate that. Thank you so much. Was this helpful? I want to see it in the chat. Thank you. Thank you so much, Brad. Thank you, Matt. Thank you. Thank you. Thank you.